So comprehensive credit reporting, or CCR as it's known as for short, was a change to what data credit bureaus can hold. So it meant that credit bureaus could start to be able to know which credit repayments an individual had made over their past 2 years. And that gave new insights into which individuals were of increased financial stress or not. This industry change created two different sets of credit providers, those that shifted to comprehensive reporting early and those that stayed under negative reporting. And effectively, a lender that's under negative reporting would not be able to see that two people to them that look identical credit risk. Actually, through comprehensive credit reporting, the one that's making all of their credit repayments on time is actually much better risk than expected. And the individual who has been missing many of their payments is actually much higher credit risk than expected. And yet the lender under the old regime just would be blind to that. And so a couple of years after CCR was released, I actually did an analysis for a credit provider who was experiencing higher than expected credit losses. So our analysis dug into whether or not potentially this lender was suffering from adverse selection. And the conclusion was that while the lender couldn't see any increasing risk in their applicant base, when viewing their applicants through the lens of comprehensive credit reporting, we could see that in actual fact, they were starting to attract more and more applicants that were falling behind on their credit repayments with other lenders, which was invisible to them under negative reporting. Now, that was a couple of years ago. I think the next wave, in my mind, of credit innovation that's going to drive potentially similar dynamics is the introduction of using banking transaction data within credit scoring models of lenders. You can actually be able to look at things like income volatility or savings balance to then be able to differentiate risk. So a similar kind of dynamic that we saw when shifting to comprehensive reporting may well happen when we shift towards more and more credit providers using transaction data for scoring. Now, yes, Carolyn, what options do lenders have if they feel that maybe they are being negatively affected by adverse selection?
They have a couple of options. The easiest but potentially most expensive option is the do nothing option. So they can just choose to wear those losses. Not many credit providers are happy with that, but that is a valid option. Typically, they could also choose to reduce their accept rates. By reducing their accept rates, they're likely to reduce their losses. The key challenge with this is they don't know which ones to decline, so they would have to cut out a whole lot of really good customers or potentially good customers, which means that their opportunity costs are there. They're then losing. If you know that something has changed in the market, like, for example, comprehensive credit reporting or the banking transaction scores, my strong advice would be to reprioritize and ensure that you actually get on board with the change and you start seeing that information that's hidden. Because that way, you can't undo what you've done, so you can't unbake the losses that are already sitting there in your portfolio, but at least it means moving forwards, you don't have to take on board all these losses. You're also mitigating against the impact of having to decline a whole bunch of customers who actually would pay you. So yeah, I would say definitely, if you're being impacted, get on board with the change and start seeing the additional information. And for those customers that are, in the space that you're talking about at the moment with the new scores, the transactional scores, I would strongly recommend that people jump and start becoming early adopters. And if not early adopters, certainly fast followers rather than late adopters.
Super interesting. Thanks so much for joining us today, Carolyn, and sharing your thoughts about the fascinating topic of adverse selection. Illion, through its transaction risk score, is actually actively supporting dozens of credit providers right now in being able to start leveraging banking transaction data within its credit scoring processes. So definitely going to be interesting over the next couple of years to watch out across the market to see whether we do notice any early adopters starting to get possibly a leg up over some of their competitors who are late adopters of transaction data. So if you would like a copy of Carolyn's book, it's available online for purchase. And on behalf of the team here at Illion and my colleague, Carolyn Rom, we hope you found this valuable. I'm Barrett Hasseldine. Thanks for watching.